Today we're going to discuss investing in gold. There's different ways to invest in gold and how much you should actually consider holding. By the end of this video, you should have a better understanding of your different options. First, we're going to talk about why people buy gold. There are three main reasons people invest in gold. First is inflation hedge. When the cost of goods rises and your dollars lose purchasing power, gold tends to hold its value. Think of it as a financial insurance against inflation. For example, in the 1970s, when inflation spiked in the US, gold prices soared from around $35 an ounce to over $800 in just a few years. Second, market volatility protection. When the stock market crashes or the economy looks uncertain, investors flock to gold. During the 2008 financial crisis, gold rose while stocks were tanking. It doesn't always go up every time the market dips, but historically, it acts as a stabilizer. Third, currency risk protection. If the dollar weakens, gold typically benefits because it's priced globally in dollars. This makes it an effective hedge if you're worried about gold economic risk. So if your goal is to protect your portfolio and stability, gold is something you should definitely consider. Now let's discuss how to invest in gold. First, there's physical gold. This includes coins, bars, or jewelry. The biggest advantage, it's tangible. You hold it in your hand, there's no counterparty risk. No company can go bankrupt and wipe out your gold. The downsides, you need storage and insurance. And liquidity can be lower if you want to sell quickly. Physical gold is best for long-term investors who value real ownership and security. The second way is gold ETFs. These are funds that track the price of gold, like GLD or IAU. They're highly liquid, easy to buy and sell, and you don't have to worry about storage. The trade-off is management fees, usually around 0.25% per year, and the price strictly follows the market. This is the easiest way for most investors to gain exposure to gold. The third way to invest in gold is gold mining stocks. You can also buy shares in companies that mine gold. This can be more volatile because the stock price depends on both the gold price and the company's performance. The upside is the potential for higher returns. If a miner discovers a new vein or operates efficiently, but their company's risk, if a mine has issues, your stock could drop even if gold is rising. The fourth way to invest, gold futures and options. This is mostly for traders. You can leverage positions and bet on short-term price movements. These are high risk and high complexity investments, not recommended for long-term investors. Really, the best way to look at this for long-term wealth building, focus on physical gold or ETFs. Now let's discuss the pros and cons of gold. A few pros. First, there's diversification. Gold often moves differently than stocks and bonds. Second, protection against inflation. Holds value when currencies weaken. Third, crisis hedge. Historically performs well during market downturns or geopolitical crisis. A few negatives: there's no yield. Unlike stocks or bonds, gold does not pay dividends or interest. Second negative is volatile price swings. Can move 10 to 20% in a year. And third negative, opportunity cost. Money in gold could underperform equities during bull markets. So gold is insurance, not growth. Think of it like as a safety net that protects your wealth rather than anything else. Now let's discuss how much gold you should own. Here's where many beginners get it wrong. People either decide to invest too heavily into gold during a crisis or completely ignore it. Those are both bad strategies. A conservative rule is 5 to 10% of your total portfolio in gold or gold ETFs for protection. If you want to invest in gold, it's better to just allocate a percentage. Also, at the most, 10 to 15% if you're really a big believer. It really depends on your own risk tolerance and your own personality. If you go above that, you start sacrificing long-term growth because gold doesn't compound like stocks or bonds. As you know, we at Josh Disclosure Investments encourage people to buy companies that have moats, growth stocks. That's such as Eli Lilly, Nvidia, Tesla, Goldman Sachs. You want long-term growth in your portfolio. But when you're investing, always consider your goals and your risk tolerance. Now let's take a quick look at historical performance. We look at over the past 30 years, gold's had an annualized return of 8 to 9%. The S&P 500 annualized return is 10 to 11%. And U.S. bonds annualized returns 5 to 6%. You gotta take a quick look. Gold doesn't outperform stocks long term, but it shines in downturns. If we take a quick look at the 2008 financial crisis, gold was up 5% and S&P 500 was down 37%. And take a quick look at the COVID crash of March 2020. Gold was up 10% and S&P 500 was down 34%. The takeaway: gold is insurance that can outperform in specific scenarios. The 2008 financial crisis is a classic example of why you have to be prepared for anything. COVID, again, was another one. So we got to think big picture. A quick thing to remember is always define your goal. Are you looking for growth, income, or protection? Second, decide allocation. Use 5 to 10% rule as your starting point. Adjust based on risk tolerance. Third, choose investment type. Physical gold for security and long term. ETFs for liquidity and simplicity, and mining stocks for optionality and slightly higher risk. You know, basically, gold is great to be combined with growth assets like stocks, income assets like bonds, and other investments. You know, diversification is the key. This is how you can grow and continue to grow over the long term. Just remember, gold is cyclical. You know, you should focus on allocation, not timing. Also, storage matters. If you own physical gold, use a secure vault or insured storage. Also consider tax implications. Gold is taxed differently depending on how you hold it. If it's ETFs, coins, or mining stocks, always do your own due diligence in every matter that we're talking about here today for investing. You can consider gold in combination with other safe haven assets like treasury inflation protected securities to further protect your portfolio against inflation and market uncertainty. So the answer to the question, is gold a good investment? The answer is yes. So that hopefully these numbers has helped you today. We appreciate everyone watching the video. Please hit the like and subscribe, and we'll make another video next week. If you have any questions, please leave them in the comments below. Hope everyone has an amazing weekend.